How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to have a great interview. I've got Jason Lange from Chatham Financial with me. Some of you may recall I did a couple of interviews with Bob Newman from Chatham Financial over the last, I would say, probably 8 or 9 months. Bob, very fortunately, has retired and is now living the good life. So Jason has kindly decided to come on and talk with us today. We're going to talk a little bit about, kind of derivatives and hedging banks' balance sheets and why that's a good thing in a declining rate environment. So with that being said, I'm going to bring Jason in. Jason, welcome to the show. How are you doing today?
I'm very good, Joe. Thanks for having me on the show today. I really appreciate it.
Yes, no, thank you for taking the time. And as I mentioned, Bob Newman, God bless him. He reached retirement and now is hopefully spending his days doing really good, fun things. And like I said, you were kind enough to kind of take his spot and willing to kind of come on and continue to talk with us about all the good things that Chatham is doing and ways that Chatham's products can help banks out there in the marketplace. So could you maybe tell us a little bit about yourself since you're kind of new to the audience?
Yeah, sure. And maybe just to tell a little bit about myself, I'll probably share a little bit about Chatham first.
Sure.
Chatham is really a global capital markets solutions and technology company. We specialize in debt and derivatives and asset advisory and technology solutions. And this is across a variety of sectors and industries. That includes real estate, corporations, private equity firms, and of course, financial institutions. I personally focus on community and regional banks, credit unions, financial services firms, and I help them with interest rate risk, currency risk, and commodity risk, as well as capital advisory, valuations, and hedge accounting. Our clients really know us here at Chatham for our deep expertise in capital markets and our technology delivery platform, which we refer to as Chatham Direct. I've been here at Chatham for 16 years. It'll be 17 in January. And most of that time, almost all of that time, has been in the service of community and regional banks and financial services companies.
Very nice. Very nice. Did you do anything before Chatham, or were you always in kind of financial services, or was this kind of your first foray into the financial services world?
Yeah. So by way of school going way back, I finished my bachelor's degree and went into the Army right away. I served nearly 8 years as an Army aviation officer. And then coming out of the military, I was an engineer by background, and I thought, let me try my hand at that. I joined a company that did air separation, distilling, liquefying and distilling air into its constituent elements for industrial applications, and then I joined a different part of that company, and from there I went back to business school. And in getting an MBA, I was able to meet and to learn about Chatham and all the great things that were going on here. And I was very fortunate to join the firm at that time.
That is really cool, Jason. And let me tell you, thank you very much for your service. I know we're past Veterans Day, but I always love the veterans. I have a huge military fan. I myself did not serve, but I have a huge I have lots of family members that have served in the military, going all the way back to before World War II and Vietnam and Korea and everything else. So I have a lot of history. So I have a lot of respect for that. So thank you very much for your military service. And I'll tell you what, we'll have to save it for probably another day. But it sounds like you did some really cool things in your time in the military. I mean, that sounds like some really interesting stuff that you were doing there.
Yeah, I was happy to. I like to think of it as I'm glad I did everything I did, and I'm also glad I'm done with it. It's a difficult, demanding lifestyle. I greatly appreciate the opportunity I had to do all of that, and I definitely learned a lot from those years. But I was happy to move forward as well.
Nice. No, I love it. Well, thank you very much for that, and thanks for giving us a little bit of your background there. So with that being said, I want to just bring this in for just a second. So I saw this article in Bank Director, And this was basically called, why loan hedging makes sense in a falling rate environment. And as we, to add a little bit of context here, as we all know, the Federal Reserve has now started decreasing interest rates. They've made 2 rate cuts, taking us down a total of 75 basis points here, roughly in the last 2 months. And we're anticipating over the next 12 to 18 months, the Fed is probably going to continue reducing rates down, maybe as much as another 100 to 200 basis points in that time frame. We'll have to see, what happens. But banks, because of this, banks now really have to change their thinking. Before, for about a year and a half, we had the Fed going on one of their most aggressive rate tightening cycles that they've ever gone on, raising the rates, I believe it was 11 times over the course of about a year. And then they took a pause for a while. And so, and that really caused a lot of issues with banks' balance sheets in terms of, what they call like unrealized losses in banks'
Sure.
bond portfolios and things like that. So now we've kind of, we've switched gears. The Fed thinks for the moment they've got inflation kind of under control, and now we're going the opposite direction, having rates come down. And so I thought, this article said, hey, this is a great time. Let's get Jason on and basically talk about what do you think banks should be doing in terms of thinking about their balance sheets, and how can those things maybe help them out in a declining rate environment right now?
Yeah, sure. Thanks, Joe. And I need to preface this just to remind the audience, we're going to be talking about interest rate derivatives, interest rate swaps, and option products. And I have to remind the audience that those transactions do have risk associated with those transactions. And so, you need to consult your risk managers and risk advisors to make sure that they're right for you. But in terms of financial institutions preparing for the decline in short-term interest rates, and that's really been something that's been going on for a while now, there's a lot of great opportunity that comes with that. Certainly you're going to see your interest expense, should see interest expense reduce as a result of that. And you would think that most financial institutions will, in fact, benefit from the decline in short-term rates. But, our own background and information and working with financial institutions, we do see quite a few clients still exposed to rising interest rates, or said another way, higher for longer interest rates. So there's still quite a bit of hedging that's going on associated with that side of the transaction. Paying fixed against short-term advances, for example, from the home loan bank, or even against, on the asset side, against pools of fixed rate assets, both of which would assist with liability sensitivity, which again, you would think that that's going to be something less required as we see a decline in short-term rates. But the opposite, we also see clients preparing for that. And one of the ways that they're doing that is establishing their customer hedging programs now. These are back-to-back swap programs, for example. And what that does is that's going to give them the ability to offer loans to customers at attractive floating interest rates, but then tied to or in connection with an interest rate swap. You would think, again, I'm putting floating rate assets on the balance sheet and I'm going to see a decline in short-term rates. Why would that be beneficial? Well, the demand, we anticipate, or we would think that the demand for these products would increase as we see short-term rates decrease. Not so much from the floating rate itself, but from the ability to potentially offer better or more attractive longer-term fixed rates in the market. Okay. And that's going to come from the swap solution rather than, in most cases, the fixed rate loan solution that many clients would typically offer.
Okay, very interesting. And then, and just for the audience, I just want to put it out there. I did 2 interviews with Bob Newman, like I said, a few months back. And the interesting thing that we did in those interviews was the first episode, or the first interview, was really focused on kind of Chatham and the products and services, things that you guys do. The second interview we actually walk through an entire example of kind of what Bob described as like a vanilla derivatives contract. So,
Sure.
and the only reason I say that is because if anybody that's listening to this is interested in maybe learning a little bit more about that, go back and check out those 2 interviews. I will put links to those interviews in the description below if anybody wants to go check those out. So, like I said, I just wanted to put that out there so that way you're not, maybe feeling lost when you're listening to some of the things that Jason is describing here. And like I said, a good homework assignment for you. Go back, watch those interviews, and then you come back and you might get a little bit more from this interview as Jason and I are discussing some of these things. So, but like I said, yeah, just wanted to throw that out there. So, well, let me ask you this, Jason, because I want to walk through kind of a couple different things here, and just to get your take on it. So, one of the interesting things that we're seeing right now is that the Fed is bringing down their federal funds rate. We're seeing the 10-year Treasury bill going up, and it's almost like a break-even type scenario. If that trend continues, let's just say hypothetically, the Fed brings their federal funds rate down another 100 basis points, and let's say we see the 10-year T-bill go up to, I don't know, 5%, so say the federal funds rate is down at like 3.75, the 10-year T-bill is up at 5%. You have this kind of a little bit of like a mismatch there, and that can kind of cause its own issues. But any thoughts on that kind of scenario? Like if we would to continue to see that scenario play out in the market, maybe different things that a bank would think about in that, that scenario.
Yeah. No, this is where the back-to-back programs that clients have established or that they're looking to establish would be extremely helpful in terms of managing risk associated with those falling interest rates. So just to remind the listeners, the result of a successful back-to-back swap is a floating rate loan on the balance sheet. And if you're doing this programmatically, you have a number of those, of course. What that does is that creates a nice pool to then, to the extent that your risk position supports this, to then receive fixed against that pool. So as we see the rising interest rates on the long end, clients can dial in an appropriate exposure to longer term rates using the pools of floating rate loans that they've created from their swap program. So the end result of that is, I can dial in, for example, a 3-year, a 5-year synthetic fixed rate asset across a pool of a number of customer floating rate loans that are generated from the customer hedging program.
Great. Fantastic. I think, that's great. And then the other example I was thinking of was say we're sitting in an ALCO committee. And for anybody that is not familiar with that, every bank basically has what's called an asset and liability management committee, otherwise known as ALCO. And what they do in ALCO is they run a sensitivity analysis and they run a gap analysis, and they try to determine if interest rates go up 100, 200, 300 basis points, or if they go down 100, 200, 300 basis points, how is that going to affect the bank's earnings? And the banks look at, are we more asset sensitive or are we more liability sensitive? And how are rates going to move? And then they look at this thing called the gap analysis. So if most banks right now, I would say, are asset sensitive, meaning that the rate on their loans is going to reprice faster than the rate on their deposits, because interest rates drop, the loan pricing changes immediately, and maybe those deposit rates don't come down as quick. So, and in that situation, you can either have a positive gap, meaning that as the rates come down, your earnings will expand and you'll do okay. Or you could have a negative gap, meaning that as the rates get lowered, your earnings you basically have what's called margin compression, and your margin gets squeezed, therefore your earnings drop, and it could cause some issues in the short term. So, and I know that was a little long-winded, but if you're a bank that's negatively gapped, and as rates come down, at least in the short run, over say a 6 to 12 month period of time, your earnings are going to get squeezed and you're going to feel margin compression. What might be something that a bank that is kind of staring down that scenario? What's something that they might think about that might be able to help them a little bit in that case?
Yeah, that really comes back to kind of the two levers you have are to lengthen the duration of your assets or kind of shorten the duration of your liabilities. To the extent that that short-term interest rates are maybe sticky and a little bit higher, that may be less attractive. So on the asset side, that's where we would come back to the pools of floating rate assets. I mentioned floating rate loans from the customer hedging program. There's certainly other ones out there, though. On the liability side, though, it's not uncommon to see significant savings using interest rate swaps with short-term advances versus maybe a traditional term advance, a longer-term advance. So it could be attractive from a cost-save perspective to still consider looking at the liability side and maybe instead of borrowing from the home loan bank at the 2 or 3 or 4 year point with a fixed advance, to then instead consider doing that with a rolling short-term advance, perhaps a monthly or a quarterly advance or something like that. And then if you need the funding at the 2 or 3 year point, the alternative using an interest rate swap to accomplish that along with the short-term funding could give you a cost save. It's not uncommon to see cost saves of 25 to 50 basis points, depending on the tenor, depending on the term you use for your short-term funding, et cetera. So it's something to consider, certainly.
Oh, no, and that's fantastic, Jason. And I think that's a great point that you make there, is that, banks should be looking not only at the asset side, but at the liability side also, and that you guys have options for both and managing risk on both sides of the balance sheet, which I think is great, because I think, a lot of times, like I said, the article that I had mentioned briefly earlier, I think a lot of times you kind of see these articles out there and they're mainly focused on loans. It's basically like, oh yeah, okay, well here's what we could do on the loan side. But I think sometimes the deposit side gets forgotten, liability side gets forgotten. And it's kind of like, hey, oh, we can do stuff over there. So it's good. So I'm glad you mentioned that and brought that up, because I think that's great, things for banks to consider. So, but Eddie, before we kind of move on to our final topic off of this, any kind of final thoughts on this, or any kind of final comments on things you think that banks might want to think about in this particular interest rate environment?
Yeah, thanks, Joe. We're talking a little bit about scenarios that may or may not play out, but it really does. If you just think about fundamentals, it comes back to an institution's own interest rate risk position, right? And that's something they're measuring through their ALCO. They're determining their sensitivity to rising or falling interest rates. And the reason we're seeing hedging for rising rates or higher for longer, and different institutions hedging for falling interest rates, is because their unique individual institutional exposures require that or dictate that. So the hedging instruments that are available to financial institutions support their own risk positions and what they'd like to accomplish or what they need to do to stay within their policy limits. It's not a one size fits all. We can look at either side of the balance sheet, but we're fundamentally going to come back to what is the exposure for that specific institution. Are they harmed, or do they benefit from the change in rates, and what can we do to mitigate those exposures? And it's going to be different for each institution.
Oh, fantastic. No, I think that is excellent advice, Jason. And like I said, I'm glad you put that forward. All right, so let's just switch gears here real quick. The final topic thing. So I always ask this of everyone I interview. So do you have a favorite business related book or a favorite business related movie?
Thanks, Joe. I don't think about that too often, but when I do, I come back to Michael Lewis books for sure. And I still come back to one of the very first ones I read, Liar's Poker. One of the really interesting lessons there for me personally was the how I learned, or where I better understood that, past performance is not really indicative of future outcomes, certainly. And the idea that you can read the tea leaves or read the charts, for example, and understand where the future rates are going to be is something that from a lesson perspective I took away that's certainly not the case, and that stayed with me my whole career. Even as I think about what we do on the interest rate side with derivatives, we do have a lot of data on historical movements of short-term rates, and then we overlay the predictions at the time in the past of where the forward curve would be, and it's wrong more often than it's right. So you have that backdrop of the inability, the imprecision of being able to predict where things are going to be or where they're going to go, and that just kind of gave me that first idea, liar's poker, that was kind of a fallacy, that you can use that information to figure out where the future lies. So that's the book.
Yeah, no, absolutely. And I love it. And I think Liar's Poker is an absolute classic. And if people have not read that book, they absolutely should. For kind of like the 1980s time period that's based in, I think a lot of people look at Tom Wolfe wrote Bonfire of the Vanities. And in that book, he got the classic phrase "masters of the universe" in that book. But I don't know. I read both, and I always, my preference is more toward Liar's Poker. I think Liar's Poker is I think it's a little bit better of a story. I think it's in some respects it's a little bit more entertaining in certain ways. And it's one of the few Michael Lewis books that hasn't been actually made into a movie, which is kind of interesting. Which it very easily could be made into a movie, and I think it'd probably be a great one. But like I said, there are some great lessons to be learned in that book, and I'm glad that you brought that up and you pointed that out, because I would tell anybody, if you haven't read that book, definitely go back and check it out. It's a great read. You'll love it. It's very entertaining, and there's some great lessons, just as Jason said, to be learned from that book. And then so I guess that's basically it. That's all I got for you today, Jason. And, like I said, I really, really appreciate you taking the time to come on with us today. I thought this was a great conversation. And like I said, if you ever have anything that you want to share as things unfold here over the next year or so, if you think there's something important that, banks or your clients or anybody out there in the general audience would like to know, like I said, we're always here. We'd love to have you come back.
I really appreciate it, Joe. Thank you so much for the opportunity. Would love to be back with you.
Great. Hey, thank you so much, Jason. All right, everybody. That was Jason Lange with Chatham Financial. Like I said, I'm going to put links to the first two interviews that I did with Bob Newman in the description down below, if everybody would like to go check those out. I'm sure that it won't be long before we have Jason back with us again. And so I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Please be sure to leave your comments down below, as I love getting back to everybody. Remember, we are on YouTube, Rumble, and all major podcast platforms. And please make sure to check out some of the other content on the channel. And I will be back to see everybody again real soon. Thanks a lot.